Hello students, welcome to the lecture on accounting process, recording of transaction, and after this lecture you will be able to learn the following objectives. Explain accounting process. Define the accounting equation and transaction analysis. Explain classification of accounts. Discuss the concept of double entry bookkeeping system. Explain the journal entry. Describe subsidiary books and their types. Now let us know more about accounting process. Accounting process is very important for an organization as it helps to maintain the systematic records of all the financial transactions and avoid any possible errors. The accounting process is designed to determine the economic impact of the transactions on the business. The overall accounting process comprises the process of identification, measurement and communication of the financial information of the organization to the interested users. Accounting process comprises 4 interconnected phases. The first phase is of recording the transactions, which is known as journalization. The second phase is the ledger posting, in which all the accounts are classified and the balance of each account is determined. In the third phase, the trial balance is prepared, in which all the ledger accounts are arranged and aggregated into debit and credit balances, which need to be equal. The trial balance helps in checking the arithmetic accuracy of the recorded accounts. In the final or the fourth phase, financial statements are prepared at the end of the accounting period, which involve the profit and loss account and the balance sheet. Accounting process. The financial accounting process consists of categorizing past transactions and events, measuring selected attributes of those transactions and events, and recording and summarizing those measurements. The first step places transactions and events into categories that reflect their type or nature. Some of the categories used in financial accounting include purchases of inventory, merchandise acquired for resale, sales of inventory, wage payments to workers. The next step assigns a value to the transactions and events. The attribute measured is the fair value of the transaction on the exchange date. This is usually indicated by the amount of cash that changes hands. The initial valuation is not subsequently changed. This original measurement is called historical cost. The final step in the process is to record and meaningfully summarize these measurements. Summarizing is necessary because otherwise decision makers would be overwhelmed with an extremely large array of information. Financial accounting cycle. The financial accounting cycle is the process of recording business transactions and processing account data to generate useful financial information. That is, financial statements including income statement, balance sheet, cash flow statement, and statement of shareholders' equity. The time period principle requires that a business should prepare its financial statements after a specified period of time, say a year, a quarter, or on a monthly basis. Major steps in accounting cycle are analyzing and recording, transactions via journal entries, posting transactions to ledger accounts, preparing unadjusted trial balance, preparing adjusting entries at the end of the period, preparing adjusted trial balance, preparing financial statements, closing temporary accounts via closing entries, preparing post-closing trial balance, accounting equation and transaction analysis. The recording of business transaction in books of accounts is based on a fundamental equation called accounting equation. Whatever business possesses in the form of assets is financed by prioriter or by outsiders. This equation expresses the equality of assets on one side and the claims of outsiders, liabilities, and owners or proprietors on the other side. Every business concern generally borrows money from outsiders in order to carry on its activities. In other words, every business concern owns money to outsiders. These assets are financed by the funds supplied by proprietors and outsiders. Money borrowed from outsiders is called as liability. Effect of transactions on accounting equations. The assets, liabilities and capital are the three basic elements of every business transaction, and their relationship is expressed in the form of accounting equation which always remains equal. At any point of time, there can be a change in the individual assets, liability or capital, but the two sides of the accounting remains equal. Combination of the equation. The interrelationship between assets, liabilities and capital can be expressed in various forms. Journalizing transactions. Transactions are analyzed into debit and credit parts before information is recorded. A form for recording transactions is chronological order, is called recording transactions in a journal is called journalizing. Transactions could be recorded in the accounting equation. However, most companies wish to create a more permanent record by recording transactions in a journal. The word journal comes from the Latin diurnal, is meaning daily. Most businesses conduct transactions every day. To keep from getting overloaded, the businesses will make entries in their accounting journals every day. In order to journalize a transaction, you need to have the source document for that entry or a listing of transactions. Source document abbreviations are as follows: check C, memorandum M, receipt R, invoice I. There are certain columns to be kept in mind: date of transaction, title of account, source document, type and number, posting reference, amount to be debited, amount to be credited. Classification of accounts. An account is the basic building block of the accounting system of an organization. A separate account is maintained for each asset, liability, owner's capital, revenue and expense item. It is used to record increase and decrease in these items resulting from financial transactions. The financial transactions can be classified into three categories: transactions related to individuals, transactions related to property and assets, transaction related to income and expense. These transactions need to be recorded to determine whether the amount is credited or debited. A transaction record of an individual or an organization is called account. For each of the assets, liabilities, owner's capital, revenue and expense items, a separate account is prepared. The description of different types of accounts is as follows. Personal accounts refers to the account of an organization or an individual. Personal account can be of following types. Natural account refers to the accounts that record transactions related to an individual person. Examples of natural account are Rahul's account and Kavita's account. Artificial account refers to accounts that record transactions related to entities such as company, institution, bank and firm. Representative account refers to accounts that represent a certain person or a group of persons. Impersonal account represents the accounts that are not related to the personal accounts. In other words, impersonal accounts do not relate to any individual or any physical entity. They can be further classified as follows. Real account refers to accounts that record transactions related to a property or an asset such as furniture, land or house. Real accounts are also classified into two accounts. Tangible account refers to accounts related to assets having a physical existence that can be touched, seen, measured, purchased and sold. Intangible account refers to accounts related to assets that cannot be perceived, be senses, but measured in terms of value such as goodwill, patents, trademarks and copyrights. Nominal account refers to the accounts that record transactions related to expenses, losses, profits and revenues. These accounts are closed at the end of an accounting period. For example, purchase account, sales account, salary account, rent account, commission account and discount account. Double entry system. Under this system of accounting, every transaction in business involves at least two accounts. That is why this system of accounting is called the double entry system. Under this system, every transaction has two aspects, that is, debit aspect and credit aspect. Under this system, every transaction is entered into at least two accounts in the ledger. In one account, the transaction is entered on the left-hand side, that is, on the debit side of the account, and on the other account, an entry for equal is made on the right side of the account, that is, the credit side of the account. Double entry system is complete and scientific system. It is simple and efficient. Each business transaction affects the accounting elements in at least two ways, that is, debit and credit. And this process of recording transaction is called double entry system. For each transaction, the basic accounting equation, assets is equal to liabilities plus owner's equity, is affected. Significance of double entry bookkeeping system. The double entry bookkeeping system forms the basis of GAAP. It makes two entries for one transaction and is a very significant method of recording financial transactions in an efficient manner. This system is of practical importance as it helps in detecting errors in the accounting system. In addition, it allows the stakeholders and other users to receive an accurate financial report, the status of the financial performance, and the position of the organization. Rules for debit and credit. The debit and credit are the most fundamental concepts of accounting, which represent two sides of each individual transaction recorded in the books of accounts. As explained earlier, every transaction has two aspects, the aspect of receiving and giving. The aspect of receiving is also known as the debit aspect, while the aspect of giving is known as the credit aspect. Let us now learn how the rules of debit and credit are used in these different types of accounts, which is described as follows. In case of personal accounts, a debit in the personal account implies that the person whose account is debited becomes a debtor. Thus, when goods are sold on credit to a customer, then he/she becomes the debtor of the business. The debtor is the receiver and the creditor is the giver. In case of real accounts, a debit in the real account implies that an asset is purchased. Any further debit in the real account means more acquisition of the asset, and this would increase the value of asset. Any credit in the real account implies that some part or whole of the asset is sold off, and this would reduce the value of the asset. Here the debtor is what comes in and creditor is what goes out. In case of nominal account, a debt in a nominal account implies that either expenditure has been incurred, some loss has taken place, or some income has diminished by the amount of the debit. Credit in a nominal account signifies that income or profit is earned. The debtor is all expenses and losses, and creditor is all income and gains.
In this video, we are going to look at recording financial transactions using debits and credits in double entry accounting. Whether dealing with personal or business financial transactions, the same concepts apply for both, just some of the terminology varies. Let's have a look at some personal terms translated into business terms. Assets are referred to as fixed assets. Credit card is equivalent to accounts payable, which is any short-term payments to be made in the next 30, 60, or 90 days. Net worth becomes owner's equity, and salary becomes revenue, which is sales and services. In addition to these translated terms, there are a couple of business-specific terms worth knowing. Accounts receivable records all accounts sent to clients for sales or services which have not been paid yet. Capital/withdrawals relate to owner's equity and keep track of what the owner invests into the business and what he or she withdraws from the business for personal use. If there is more than one owner, then there will be a capital and withdrawal for each owner. The debit and credit system is the backbone of double entry accounting and is used by businesses to record all financial activity. Meet Jill. She owns a coffee bar called the Java Lounge and tracks all of her financial transactions using the double entry accounting system. To make sense of how debits and credits work, The first step is to understand the types of accounts used by Jill to record transactions made by the Java Lounge. Assets are those things of value that the business owns, like the cash in the Java Lounge's general bank account, the tables and chairs that customers use, the coffee maker and other equipment that staff use to make the coffee, and the cash register that is used to complete an order. Jill allows well-known customers to run a tab, considered accounts receivable, which is an asset, since the Java Lounge has the right to the future collection of the money. Let's have a look at some other types of accounts. Liabilities can be thought of as the opposite of assets. These are obligations of the business to make payments to another company or to the government, i.e. HST, income tax, payroll deductions, which are listed as accrued liability accounts. Accounts payable, which are short-term obligations on credit, is a liability since they represent the company's future duty to pay someone. So is the loan Jill took from the bank a few months ago to cover the cost of some renovations, which would be recorded in the loans payable account used for loans and longer-term obligations. Owner's equity is the owner's claim on the assets of the business. During each financial period, a record is kept of Jill's contributions to the business by way of personal funds or assets. The Jill Capital Account is used for this purpose. Also, a record is kept of Jill's withdrawals of cash for personal reasons. The Jill Withdrawals Account is used for this purpose. Income and revenue accounts are just as they indicate. They track where the company gets its income from. Jill's Coffee Sales Account records any coffee sales the Java Lounge makes. Expense accounts, again, are just as they indicate, a means of tracking the business's expenses. Most companies have a separate account for each type of expense they incur. The detail of expenses is unique to each company. The Java Lounge's expense accounts track things such as rent, hydro, coffee supplies like beans, milk, sugar, etc. Now that you have an understanding of account types, let's look at how financial transactions are recorded. For every financial transaction, there must be a debit entry and a credit entry recorded. There will always be two entries of equal value for each transaction. This is the basis of double entry accounting. One entry will always be a debit and one will always be a credit. But remember that this does not mean that one entry has to be negative and one positive. Let's look at an example. Jill decides to add more seating to the Java Lounge, so she spends $550 to buy some new lounge chairs. Since business has been good and Jill has some cash in the bank, she's going to pay $550 for the chairs with cash out of the bank account. This part of the transaction is recorded as a credit to the bank account since it is decreasing the bank account. The new lounge chairs are considered an asset and are recorded in the furniture account as a $550 debit since these new chairs increase the furniture assets. Double entry accounting is based on the fundamental accounting equation. Assets equal liabilities plus owner's equity. For this equation to work, there must always be a debit entry and a credit entry recorded for everything to balance. In the end, all debits must equal all credits. If they don't, the entry is out of balance, and this will throw off all of the balances for the system. Depending on what type of account you are dealing with, a debit or credit will either increase or decrease the balance of that particular account. This is the difficult part for beginners. The good news is that if you can memorize this T-chart, you will be able to determine whether a debit or credit will increase or decrease the balance of a particular account. Let's look back to one of the examples. When Jill decided to do renovations to the cafe, she needed a bank loan to cover the costs. This transaction was recorded in a liability account called loans payable. Since this account is a liability, it will increase with a credit. The bank account will increase with a debit, since it is an asset, to show the money from the loan going into the bank account. That's debits and credits and double entry accounting in a nutshell.
Journal entry. A journal is a primary book of accounts in which all transactions of a business are recorded in the form of entries. You can also define the journal as a chronological, in order of date, record of then transactions of a business. The process of recording a transaction in a journal is known as journalizing. Date. Records the date when a transaction is made. Particulars. Records the name of the debit and credit accounts affected by a transaction. The debit account is written at the left side of the particulars column. Doctor is written at the right side, and the credit account is written in the next line with the prefix to. Narration is a brief description of the transaction. Ledger folio, LF, records the page number of the ledger on which the debit and credit accounts are posted. Debit amount records the debited amount. Credit amount records the credited amount. Steps in journalizing. The following steps are performed. Ascertain the accounts are affected by the transaction. Ascertain the nature of the account which is affected. Ascertain the account to be debited and the amount to be credited by applying the rules of debit and credit. Ascertain the amount by which the accounts are to be debited and credited. Record the date and month of the transaction in the date column and the year at the top. Record in the particular column the name of the account to be debited. Along with the name of the account, the abbreviation Doctor should also be written in the same line against the name of the account. Write the amount to be debited in the debit amount column. Record in the particular column the name of the account to be credited. The name of the account to be credited should be written in the next line preceded. The word to is written towards the right after leaving few spaces. Write the amount to be credited in the credit amount column. Record a brief description of the transaction starting from the next line in the particulars column. This brief description of the transaction is termed as narration. Draw a line across the particulars column to separate one journal entry from the other. Compound journal entry refers to two or more transactions of the same nature that occur on the same date. Such transactions are recorded in one journal entry instead of having a separate entry for each transaction. For example, recording two or more accounts to be debited and one account to be credited. For example, on 28 March 2010, Rs 5,000 is paid for rent and Rs 3,500 is paid for freight. Ledger books. Ledger is a book or register in which transactions are permanently recorded, summarized and classified. A journal is organized as a chronological record of transactions and a ledger is organized by account. The ledger accounts are arranged under particular headings and help in preparing trial balance, after which the final statement is prepared. A ledger is also known as principal book. In a ledger, each account is divided into two sides, the debit side and the credit side. The left side of the ledger is called the debit side, whereas the right side of the ledger is called the credit side. Each side is further divided into four columns.
General ledger. General ledger, it is a principal ledger which contains all the accounts for balance sheet and income statement. And we use a general ledger in order to record and classify all items of a financial statement separately. And also we use general ledger to post accounting entries or recorded transactions from general journal to separate general ledger accounts. When we have general journal and recorded transactions, we post them to general ledger. And here you can see an example. This is general journal, and in it we have one transaction. Date is indicated and details. We have cash, $15,000 increase in cash, and we have increase in share capital, also $15,000. And it is an establishment of business. And when we do the posting to the general ledger accounts, here we use T accounts, we post increase in cash to cash account And we indicate the reference in the brackets, it's 1, in order to trace back, if it is necessary, which transaction was posted in the general ledger. And also we have share capital account, and we post from general journal credit entry to share capital account, and again indicating the same reference to the number of the transaction. And posting means that we record general journal entries or general journal data in separate general ledger accounts.
The following is a brief description of these columns. Date records a date on which a transaction is made. Particulars records the names of the accounts to be credited on the debit side and the accounts debited on the credit side. Journal folio JF records the page number of the journal on which the posting of the ledger place. Amount records the amount of each transaction. Difference between journal and ledger. The journal and the ledger are the most important books of the double entry bookkeeping system of accounting and are indispensable for a proper system. These books are closely related to each other. Journal. A journal is a book of first entry. It is a book for chronological records. It is a book of source entry and carries more weight as legal evidence than the ledger. The unit of classification of data in journal book is the transaction. The process of recording is called journalizing. Ledger. It is a book of second entry. It is a book for analytical records. It is a book that follows journal entry. The unit of classification of data in ledger books is the account. The process of recording is called posting. Posting in the ledger. Posting refers to the method of transferring the details of a transaction from a journal to a ledger. Transactions are posted to a ledger periodically, such as weekly or monthly, according to convenience. Perform the following steps to post the transactions of a journal to a ledger. Create the ledger accounts. These accounts are based on the accounts recorded in the corresponding journal. Enter the date of a transaction in the date column. Post the debited transaction of the journal entry to the credit side of the account, which is credited in the journal entry. Similarly, post the credited transaction of the journal entry to the debit side of the account, which is debited in the journal entry. Begin the debit side with to and credit side with by. Enter the page number of the journal from where the transaction is transferred to the ledger in JF column. Balancing the ledger. Balancing an account means totaling the amount of both sides, that is, the credit side and the debit side of the account, and writing the difference to the side whose total is less. Perform the following steps to balance an account. Calculate the amount of both the debit and credit sides of the account separately. Calculate the difference of both sides. If there is no difference, it means that the balance is nil. If the total of the debit side is greater than the total of the credit side, the difference is written on the credit side, and if the total of the credit side is greater than the total of the debit side, the difference is written on the debit side. Type the balance as to balance CD if the difference is on the debit side. The word CD means carried down to the next period. Similarly, type the balance as to balance BD if the difference is on the credit side. The word BD means brought down from an earlier period. A period refers to any duration such as a month or 3 months, quarterly according to convenience. Calculate the credit and debit totals at their respective sides of the accounts. Subsidiary books. A large number of business transactions take place, which makes it difficult to record all the transactions in one prime book. For convenience, a separate book is maintained for similar type of transactions, such as one book for receipts and payments of cash and another one for sale of goods and their purchases. A journal can be divided into a number of subsidiary books, which are cash book. Includes the records of all the receipts and payments made by cash and checks. The cash book, which is used to record cash as well as bank transactions, is known as bank book. The cash book has two sides, namely the left side, which records all the cash receipts, and the right side records all the cash payments. The special feature of the cash book is that it functions as a journal and a ledger with regard to the cash and bank transactions respectively. Purchase book involves the records of the credit purchases of goods. However, the cash purchases of goods or the credit purchases of assets are not recorded in this book. Purchase returns book includes the records of the return of goods and materials sent back to the suppliers. It is also called return outward book. Sales book involves the records of all the credit sales of goods. However, it does not record the cash sales of goods or credit sales of assets. It is also known as sales journal. Sales returns book includes the records of the returns of the credit sales received back from the customers. It is also known as the return inwards book. Bills payable book involves the records of all the issues of promissory notes or bills of exchange accepted by the business regarding the amount owed to the suppliers. Journal proper constitutes the records of the transactions which cannot be recorded in other subsidiary books. It usually records the transactions that are of infrequent nature, such as adjustment entries, opening and closing entries, and interest on capital. Now, in the end, let us summarize what we have learnt in this lecture. Accounting process is very important for an organization as it helps to maintain the systematic records of all the financial transactions and avoid any possible errors. The financial accounting process consists of categorizing past transactions and events, measuring selected attributes of those transactions and events, and recording and summarizing those measurements. The recording of business transaction in books of accounts is based on a fundamental equation called accounting equation. The debit and credit are the most fundamental concepts of accounting, which represent two sides of each individual transaction recorded in the books of accounts. The financial accounting cycle is the process of recording business transactions and processing account data to generate useful financial information. That is, financial statements including income statement, balance sheet, cash flow statement, and statement of shareholders' equity.